Venture capital is like high-octane fuel for startups. It propels them forward at an incredible speed, giving them the boost they need to break through barriers and reach new heights. It provides the financial muscle for young companies to grow from small ideas into big businesses. With the right funding, a startup can transform its vision into reality, turning innovative concepts into market-ready products and services. These investors, known as VCs, bet on promising startups, providing capital in exchange for a share of the company. They bring not just money, but also expertise, mentorship, and valuable industry connections that can open doors and create opportunities. This injection of funds can be a game changer, enabling startups to hire top talent, invest in cutting-edge technology, and reach new customers. It allows them to scale rapidly, outpacing competitors and capturing market share. In the Indian startup ecosystem, venture capital has played a crucial role in fueling the rise of tech giants like Flipkart and Paytm. These companies have become household names, thanks in large part to the strategic investments and support from venture capitalists. However, like any powerful tool, venture capital has its downsides. The pressure to deliver rapid growth and high returns can be immense, leading to stress and burnout among startup teams. While it can be a catalyst for innovation and growth, it can also lead to disastrous consequences if not handled carefully. Mismanagement of funds, unrealistic expectations, and strategic missteps can cause startups to falter and fail. This essay will explore the dark side of venture capital, examining how its influence can sometimes harm the very companies it aims to support. We'll delve into real-world examples and case studies to understand the complexities and challenges involved. By understanding these potential pitfalls, entrepreneurs and investors can work together to create a healthier and more sustainable startup ecosystem in India. It's about finding the right balance between ambition and caution, growth and stability, to ensure long-term success. Ultimately, the goal is to harness the power of venture capital to drive innovation and economic growth, while also safeguarding the well-being of the entrepreneurs and teams who are at the heart of these ventures. With thoughtful planning and strategic partnerships, the future of the Indian startup ecosystem looks bright and promising. One of the biggest dangers of venture capital is the relentless pressure for rapid growth. This pressure can be overwhelming for startups, especially those in their nascent stages, trying to find their footing in a competitive market. VCs typically seek high returns on their investments, and they often have a timeline in mind. They want to see their investments grow exponentially within a few years. To achieve these high returns, venture capitalists often push startups to scale up quickly. This means increasing their customer base, expanding their product lines, and entering new markets at a breakneck speed. This pressure can lead founders to make hasty decisions, prioritizing short-term gains over long-term sustainability. The focus shifts from building a solid foundation to achieving rapid growth metrics that can impress investors. For example, a company might be tempted to burn through cash to acquire customers at an unsustainable rate, sacrificing profitability for market share. They might invest heavily in marketing campaigns, offering deep discounts and promotions to attract new users. This growth at all costs mentality can have severe consequences. When the initial excitement fades and the promotional budgets dry up, these companies often find themselves struggling to retain customers and maintain their market position. Companies may overspend on marketing, hire too many employees too quickly, or expand into new markets before they are ready. This rapid expansion can lead to a host of problems, including mismanagement, lack of focus, and operational inefficiencies. These actions constrain resources, create operational inefficiencies, and ultimately lead to failure. The initial promise of rapid growth can quickly turn into a nightmare of dwindling resources and mounting debts. In the Indian context, several startups that raise significant venture capital have faltered due to unsustainable growth strategies. Despite the initial influx of funds, they were unable to maintain their growth trajectory and eventually faced closure or significant downsizing. However, it's not all doom and gloom. There are success stories of startups that have managed to balance growth with sustainability. These companies focus on building a strong foundation, understanding their market, and growing at a pace that they can manage. Learning from the failures of others, new entrepreneurs can adopt a more measured approach. Seeking advice from mentors, focusing on core competencies, and ensuring that growth strategies are sustainable can help in building a resilient business. In conclusion, while venture capital can provide the necessary funds to fuel growth, it's crucial for startups to balance this with sustainable practices. Growth should not come at the cost of the company's long-term viability. By focusing on sustainable growth, startups can build a lasting legacy. Another risk associated with venture capital is the potential for conflict between founders and investors. This conflict can arise from differing priorities and expectations, which can sometimes lead to significant disagreements and even jeopardize the future of the company. While both parties share the goal of building a successful company, their approaches and end goals can vary widely. Founders often have a personal and emotional investment in their vision, while investors are more focused on financial returns. Their motivations and timelines can differ significantly. Founders may be willing to take the time needed to develop a product or service that truly stands out, whereas investors might be looking for quicker returns on their investment. Founders are often driven by a long-term vision, passionate about solving a problem or disrupting an industry. They are usually willing to put in the long hours and make personal sacrifices to see their dream come to fruition. VCs, on the other hand, are primarily focused on maximizing returns for their investors. They have a fiduciary duty to ensure that the funds they manage are growing, which often means they are looking for high-growth opportunities that can provide substantial returns. This often involves exiting their investment within a specific time frame, typically through a sale or an IPO. The pressure to achieve these exits can sometimes lead to decisions that prioritize short-term gains over long-term sustainability. This misalignment of incentives can create tension and lead to poor decision-making. For example, a founder might want to reinvest profits back into the company to fuel growth, while investors might prefer to take those profits as dividends. For instance, VCs might pressure founders to pivot their business model to chase short-term trends. This can be particularly challenging if the founder believes that sticking to the original plan is crucial for long-term success. Investors might also push for a quick sale, even if it means sacrificing the company's long-term potential. This can be a tough pill to swallow for founders who have poured their heart and soul into building their business. These conflicts can be particularly acute in the Indian startup ecosystem, where the pace of growth and the expectations of investors can sometimes clash with the traditional business practices and cultural norms. In India, the cultural emphasis on relationships and trust can sometimes complicate business decisions. Founders may feel a strong sense of loyalty to their team and their mission, which can be at odds with the more transactional nature of venture capital. The relentless pursuit of rapid growth fueled by venture capital can also stifle innovation. Building a truly innovative company takes time, experimentation, and a willingness to take risks. However, the pressure to deliver quick wins and meet quarterly targets can discourage founders from pursuing bold ideas that might take longer to materialize. This short-term focus can lead to incremental improvements rather than groundbreaking innovations. In the Indian context, where startups often face intense competition from both domestic and global players, the pressure to innovate is immense. However, the pressure to deliver quick returns to investors can sometimes hinder the development of truly disruptive technologies and business models.